In a study of 10,000 brokerage accounts, researchers found something that should make every investor uncomfortable. The accounts that traded the most active, the most confident, the most certain, underperformed the market by an average of 6.5 percentage points per year. Not the beginners, not the confused ones, not the people who admitted they didn't know what they were doing. The confident ones, the people who were sure, and buried inside that data was an even darker finding. The investors who had just experienced a big win, a stock that doubled, a call that paid off, a market read that turned out to be right. Those investors didn't become more careful. They became more aggressive. They started taking bigger positions, trading more frequently, believing at some level that they had figured something out. Within 3 years, the majority of them had given back everything they made. And then some. This is not a story about stupidity. Some of these people were doctors, lawyers, engineers, people who were genuinely intelligent in their own fields. This is a story about a specific kind of trap that the human brain builds, one that is almost invisible from the inside. It is called the Dunning-Kruger Effect. And in the stock market, it is absolutely everywhere. In 1999, two psychologists at Cornell University, David Dunning and Justin Kruger, published a paper that would go on to become one of the most cited studies in all of behavioral science. Their central finding was this: people who are incompetent in a given area tend to dramatically overestimate their own ability, not slightly dramatically. In their original experiments, students who scored in the bottom 25% on logic and grammar tests consistently believed they had scored in the top half. They weren't lying, they weren't guessing randomly. They genuinely believed they had done well. And here is the part that makes this so insidious. The very skills you need to recognize a good performance are the same skills you need to produce one. If you don't know what you don't know, you have no way of knowing that you don't know it. Dunning himself later described it this way: the first rule of the Dunning-Kruger Club is you don't know you are in the Dunning-Kruger Club. Now take that finding, that dangerous self-sealing loop of incompetence and confidence, and drop it into an environment where confidence costs money. That is the stock market. And in the stock market, the Dunning-Kruger effect doesn't just make people feel good about themselves. It makes them act. It makes them trade. It makes them bet real money on certainty they haven't earned. There is a visual that behavioral economists use to describe how confidence and competence interact over time. It is sometimes called the Dunning-Kruger curve, and it has 4 distinct phases. Phase 1 is called the peak of Mount Stupid. This is where most new investors live. They've opened their first brokerage account. They've watched some videos, read a few articles, maybe made some early trades that happen to go well, and right there, with the least amount of actual knowledge, they feel the most confident. Everything seems learnable. The patterns seem visible. The logic seems clear. They start to wonder why everyone says investing is hard. Phase 2 is the cliff. Something goes wrong. A position blows up. A market move that seemed obvious turns out to be wrong. The investor starts to realize that the variables are more complex than they appeared, that the professionals on the other side of their trades have decades of experience, that the market doesn't care what seems obvious. Confidence collapses. Some people stop investing entirely at this point. They leave the market convinced it is rigged or random or both. Phase 3 is the valley of despair. This is where the real learning begins, but it feels terrible. The investor now knows enough to understand how much they don't know. Every decision feels uncertain. Every trade feels dangerous. The confidence they had on the peak is completely gone, replaced by something that looks a lot like paralysis. Most people who make it through the valley eventually arrive at phase 4. Phase 4 is the slope of enlightenment, and eventually the plateau of sustainability. Here, confidence and competence finally align. The investor knows what they know and knows what they don't. They've developed actual strategies, actual frameworks, actual edges, and critically, they've learned the specific, irreplaceable skill of operating under uncertainty without pretending the uncertainty isn't there. The problem is that most retail investors never make it through the valley. They either blow up their accounts on the peak or they quit in the despair. The slope of enlightenment requires something most people find very hard: sitting with not knowing for a long time without giving up. Let's make this concrete, because the Dunning-Kruger effect doesn't show up as one big catastrophic mistake. It shows up as a series of small, confident ones. Pattern 1, the hot streak trap. An investor makes 3 good calls in a row. They bought a tech stock before earnings. They sold before a correction. They got back in near the bottom 3 for 3. And here's what the brain does with 3 wins. It builds a model. It decides that the wins weren't luck. They were skill, that there is a pattern, that the investor has identified something others are missing. The position sizes get bigger, the trades get more frequent. The caution that produced the original discipline starts to feel unnecessary. The 4th trade, made with more money, more confidence, and less caution than the first 3, goes wrong. sometimes badly wrong, and because the position was larger. The loss wipes out the gains from the previous wins, and then some. Pattern 2, the expert by proximity fallacy. This one is subtle. An investor works in the tech industry, so they feel they understand tech stocks. A healthcare professional thinks they have an edge on pharmaceutical companies. A real estate agent believes they can read housing market trends better than average. Sometimes this is true. Domain expertise can provide genuine informational advantages in the stocks directly related to that domain. But the Dunning-Kruger effect hijacks this entirely. The investor doesn't just feel confident about the narrow area where they have actual expertise. They generalize, the confidence bleeds, and suddenly someone who knows a lot about hospital operations feels equally confident about biotech drug trials, medical device valuations, and pharmaceutical supply chains, areas that are entirely different with entirely different risk profiles. Pattern 3. The recency bias amplifier. In a bull market, almost everyone looks like a genius. Stocks go up, picks perform, portfolios grow. And the longer a bull market runs, the more confident investors become, not because they've gotten better, but because the market has been rewarding them for longer. Then the market turns. And the investors who were most active during the bull market, who made the most trades, who took the biggest positions, who felt the most certain, are the ones most exposed when conditions change, because they had assigned their market's performance to their own skill rather than to the environment. Here's a concept that most retail investors resist deeply. When you place a trade, there is someone on the other side of it. That person or that algorithm or that institution has also looked at the stock, has also done research, has also formed a view. When you buy, someone is selling. When you sell, someone is buying. At every single price point, there is a human being or a team of human beings or $1 billion quantitative system that has looked at the exact same stock and reached the exact opposite conclusion. The question the Dunning-Kruger effect prevents investors from asking is, why do I think I am right? And they're wrong, not in an anxious, paralyzed way, but in a genuinely curious, rigorous way. What information do I have that they don't? What analysis have I done that their team hasn't? What is my actual edge here for most retail investors? The honest answer to that question is uncomfortable. The edge is often just a feeling, a heuristic, a pattern that looked obvious from a surface reading. A conviction built on familiarity rather than analysis. That doesn't mean retail investors can't win. They can, and many do, but the ones who win consistently are the ones who have asked that question honestly and built a real answer to it. The ones who lose consistently are often the ones who never ask it at all, because the confidence of the Dunning-Kruger peak makes the question feel unnecessary. So what does the escape route look like? Because there is one. It is just not comfortable. Rule 1, track your decisions, not just your outcomes. Overconfident investors track results. They remember the wins. They forget or rationalize the losses. And because memory is selective, the mental scoreboard stays tilted in their favor even when the actual account is not. The Fix is a trading journal, not a performance tracker, but a decision journal. Before every trade, write down why. What is the thesis? What would have to be true for this to work? What would prove it wrong? What is your exit if you are wrong? Then review it, not to feel good about being right, but to honestly evaluate whether the reasoning was sound, independent of whether it worked. Good reasoning that produced a loss is more valuable than a lucky win that produced nothing but misplaced confidence. Rule 2, actively seek disconfirmation. The Dunning-Kruger peak is sustained by selective attention. The investor sees evidence that supports their view and unconsciously filters out evidence that doesn't. The antidote is to deliberately search for the bear case on every position you are bullish on. Find the smartest argument against your thesis. Try to steelman it. If you can't find a compelling bear case, that is not evidence that you are right. It is evidence that you haven't looked hard enough. Rule 3, size your positions to your actual confidence level, not your felt confidence level. This is the most practical application before entering a position. Ask yourself, on a scale of 1 to 10, how certain am I that this works? Then cut that number in half. The gap between the two numbers, your felt certainty and your calibrated certainty, is the Dunning-Kruger premium. It is the amount by which your confidence exceeds your knowledge. Size the position to the calibrated number, not the felt one. Rule 4, respect what the price is already telling you. Markets are not perfectly efficient, but they are the aggregate judgment of millions of participants with enormous resources. When a stock is priced where it is, That price reflects an enormous amount of information that you may not have access to. That doesn't mean the market is always right. It means that when you disagree with the market, you need a specific, defensible reason, not just a feeling that the market is wrong. The Dunning-Kruger effect isn't a character flaw. It isn't a sign of low intelligence. It is a feature of how the human brain manages uncertainty, a feature that was probably useful in a simpler environment where confidence enabled action and action was necessary for survival. In the stock market, that same feature becomes a liability because the market doesn't reward confidence, it rewards accuracy. And the gap between confidence and accuracy, especially early in an investor's journey, can be measured directly in dollars lost. The investors who grow beyond it aren't the ones who become less confident overall. They're the ones who learn to locate their confidence precisely, to be highly certain where they genuinely have an edge, and genuinely humble where they don't, to know the difference between the two and to act accordingly. That combination, calibrated confidence applied selectively, is one of the rarest and most valuable things in investing. And it starts with a question almost no overconfident investor thinks to ask: what if I am wrong?